So this has been a tremendous three-day conference, full of unique content, unique insight and foresight regarding the maritime industry, its direction and risks, opportunities, and challenges. We are coming to the close, and we always reserve for the closing of our conference the analyst panel, where we bring the collective wisdom of Wall Street, figuratively speaking, because we also have analysts from Norway. So we bring the collective wisdom of the best analysts to discuss how they see the industry going. And I would like to thank Robert Bugbee for being always the most skillful moderator. So thank you to all. I will let Robert take over and introduce each one of you. And again, tremendous thanks for your support, help, and participation.
Nicholas, thank you. On behalf of everybody and everybody, in our industry, if I may, first, I'd just like to thank you for, really sort of helping to keep everybody together, during all the COVID and even in the worst times, holding conferences and chat rooms. So I just thought I'd like to say that from the start, from all of us. So today we've got a great lineup for the analysts, a good mix, and a good mix of people who've kind of seen bull markets before, a good mix of people who haven't. That's their first time through this, etc., and all the markets and different views here. So I want to keep it fairly loose. It's their panel. Let them take this where it's going to go. I think I'm going to start with age before beauty. So Magnus, Fyhr, if you'd like to start off, what I'd like you to do is just sort of chat a little bit about what any subject in shipping you want that's interesting you right now.
Well, thank you, Robert. I think it's been an interesting couple of days here. A lot of talk about the renewables, and I don't think we talked much about some of the good old commodities like crude, coal, and natural gas. And I think reading the headlines today in the press, we have an energy crisis that we sort of created ourselves with moving too fast into to renewables. And I think it's setting up an interesting opportunity for both dry bulk and crude, and especially the crude market, which has been lagging behind as far as stock performance, that we haven't seen any improvement in spot rates so far. But I think in order to prevent oil prices to go above $100 a barrel, we need more oil on the market. I think that's pretty obvious. And for some reason, OPEC is sticking to their tight production schedule. So I think going forward, I like the crude tankers and the product tankers as a play on a recovery of OPEC production. And the catalyst, I think once we start, going back, supply has grown 5%, demand is not back to pre-COVID levels. So there's a little bit of a growing pains here, but I think in 2022, we're going to see markets improve. And I think the crude tankers and product tankers are going to come into the spotlight again.
Great, thank you. Now we're going to go to beauty. Randy, we've seen the YouTubes. Let's see the man, see the face, and hear the opinions.
All right, I'll take that as a compliment. Thanks, Robert. So yeah, there's really a lot of positives to talk about, right? You're seeing Capesize rates at 12-year highs, LNG rates ripping every day for the last few weeks. The container ship market, the best it's ever been, right? So I'll just keep my comments kind of real big picture before we dive into some of those individual sectors. But I think for the first time in more than a decade, are we at a good point on all three kind of legs of the shipping stool, right? The supply picture is very attractive. Order books are very low. You're going to see some accelerated scrapping and slow steaming with all of the regulatory environmental regulations coming through in the next few years. So the supply picture is very attractive. Demand is also looking pretty stable, right? I think you can easily see a demand of GDP plus for at least the next few years. So it's at 3%, 5%, 6%. It really depends on the subsector, but demand growth is going to outpace supply growth pretty much across the board for the next few years. And then finally, when you look at the individual companies and balance sheets, right, especially on the dry bulk side, a couple of the tankers, container ships, they're in the best position they've been in arguably ever, right? And that's why you've seen these very large, very generous dividend payout policies being enacted. We've seen that pretty much across the board in dry bulk. We've seen increased dividends around the containers, container ships, LNG carriers, and the like. So all that being said, it's not just, well, look at demand, it's great, but the order book's at 60%. Or just look at the supply side, but demand's terrible. Or, you know, the companies have these stretched out balance sheets and CapEx and new build obligations that's going to really draw cash out for the next few years. That is not the case. And it's really the first time it's been this way in at least probably 15 years. So I'll stop there, but certainly an exciting time to be in the shipping markets.
Thank you, Randy. I apologize for my dog. He just barks whenever someone gives a shout for the product market. So it's all good.
Yeah.
Well, he'll set him off. I don't think we need that right now. Ben, thank you very much for those pins. Ben, please go for it.
Yeah, you know, I think it's you know, all of our best interests probably on this panel and maybe anybody who's even dialed in to be optimistic on the market. You know, but and I am, to be perfectly clear. I think in most categories you've got to like the setup that we're in right now. I think to sort of change course a little bit, you know, just the last time that we were here, or even close to, well, I suppose it was a lot crazier, but Magnus hired me a long time ago, a couple decades ago, and it was because we were in this sort of an environment where things were just going crazy, and capital raising, anybody with the foggiest idea of, you know, a shipping idea could raise money to do it. That is not the case now. There is some ability to raise capital, and we've seen that, but it's a very different world. And to me, honestly, despite the fact that I'm an analyst and I'm supposed to have sort of a perfect crystal ball, it does sort of cloud the picture a little bit, because ordinarily these shipping cycles provide companies an opportunity to shoot themselves in the foot. And that might still be the case, but it certainly isn't as easy as it had been in previous cycles to do that. So, you know, although again, I hate to say it this way, but it sort of lessens the value of guys like us. But nonetheless, it's an interesting world. I think it's exciting. It is, you know, fraught with opportunities but challenges, and so good to have a seat at the moment. Thankful to be here.
That's great. Thank you, Ben. I mean, look, I think you pointed out a great point that, you know, in the past, you know, it's been very simple. If Wall Street gives us children in shipping too many sweets, we're gonna get sick, and normally Wall Street ends up cleaning up the mess. So I think that's it's a great observation from what's happened before. Jorgen, let's try you. This must be your first bull market, right? Has to be.
Yeah, they tend to be quite elusive. I've read about them for sure. So happy to be part of one this time around. If you want me to point to one thing that I feel is quite interesting on how things are developing right now, I'd have to point to the interest, and of course that's probably favored by what you mentioned. That for a long time the interest in our space has been not too high, I guess. But my perception, at least, speaking to a lot of investors these days, new people that haven't really had too much interest before, starting to see the potential of this just going on and on. And I think some of the sectors that have really kicked off and sparked this upcycle are the reason for that. And right now, people are scouting out where this is headed in all of these different sectors going forward. So, to me, that's at least one of the most interesting developments in the current market. And of course, that's a lot helped by what has been mentioned in terms of the order book being very limited, and the potential right now seems extraordinary in terms of where we've been before.
Thank you. If I could, Robert, I'd just jump in. Of course. I would say that that's true. Certainly interest is higher, but Omar and Magnus can back me up. Like this is nothing compared to the glory days. The phone would ring off the hook. So it's improved, but we've got a long way to go before we're back to where we were.
Ben, I agree with that. We're definitely much busier on the phone and getting a lot of inbounds. But it's not like it was, and still it doesn't compare to the floating storage frenzy, I'd say, from last, April of 2020. I do have one follow-up, Robert, if I may, directed towards Ben. Ben, I lost what you meant when you said lessons.
Wait. Omar, you must keep this civil. There's no need to be in civil. Amit's not here.
It's not fun if it's all nice.
Okay,
go for it. No problem.
Go for it.
Yeah, I just wanted to ask Ben what he meant by what was it specifically that you're referring to that lessens our value as analysts? Because
that's a good question. So I think our value as analysts can oftentimes be when companies are trying to raise money and investors who are probably not as familiar with the space depend on the analyst to do some of the due diligence for them. And so when people aren't trying to raise money, it's more opportunistic investing on the part of the buy side, as opposed to just trying to keep up with the deal flow. I think that's a politically correct way to answer that.
That's fair. No, Ben, I appreciate that clarity, because I am sure everybody on this panel has done more calls with more generalist investors over the past several months than they have in the past several years, right? There's just been a lot of it. And this morning I did a call explaining the lay of the land for tankers for somebody who hasn't looked at it before. So I do feel that our value as analysts going into where we are in this market has become substantially higher, because there isn't a lot of IQ on Wall Street that understands shipping. And this is something we do on a daily basis, so I think honestly, our value has gone up, I think, tremendously based off of what's been going on.
Yeah.
Just my 2 cents.
I am trying to convince my director of research that all the time.
That's perfect. All right. Lars, let's hear from you.
Yeah. So I think obviously Magnus already touched upon it, but I think what's really going on in the energy markets, and I think you look at where sort of inventory levels are across at least energy commodities, but commodities in general. And I think we're seeing that in the oil market now as well. Maybe this is sort of a comeback for the old industry. And as Jorgen said, I've read about these things, but never experienced it. And the fact that it's so widespread is simply thrilling. I would say it's a lot of fun now.
Great. So, okay, I'm gonna throw a couple of things out here. So. Anybody can sort of happy to pick this up, but containers. I watched a program here yesterday, actually on the news, just the news here in the States, where they were referring to all the queuing that there was in containers and all the effort that Biden's going to make to reduce the queuing. And there was one of the United States top economists, Krugman, there making a comment, and he simply said, well, we would expect, shipping rates to fall quite substantially as the congestion decreases, because the congestion is going to decrease because, very simply, people have bought more goods while COVID has been on, as a way to comfort themselves and a substitute for the other experience in life that they have not been able to do. So would anybody, like to pick up, where does the container market go from here?
I'll jump in. That's an interesting question, and one that has been, I think, at the forefront of everyone looking at containers really for the past, I'd say 9-10 months. We came into this year with things already riding high, and I think had already set records in terms of indices and freight rates. And the next question was, okay, in 2021, we should actually start to see a moderation as people get vaccinated, as people start to become more mobile. We've seen it with travel, business and all that. But it hasn't yet actually led to any slowdown. And in fact, we've only seen an acceleration of consumer purchasing. And that's what's created now this even tighter logjam. I think the interesting thing is going to be how these next 12 months play out, because logically more people are going to be traveling. I'm going to be traveling internationally for the first time next week. I know, Ben, you were, and Randy, and I'm sure others have on this panel, have been traveling. And so that's accelerating, and it'll be interesting to see how that then parlays into how we spend our money on finished products. But it's an interesting situation that clearly congestion has picked up. But I think what seems to always get lost, at least in the discussion over the past several months, has been it's not congestion that's caused rates to be good. It's demand that's caused the congestion, and then that's what's catapulted rates higher. And so you have this backdrop of very, very strong demand, and liners for the first time in their history, as far as I can tell, are faced with a higher quality of earnings than they had before, where they're able to now negotiate freight contracts that normally would be 12 months at a time. They've now extended to 24 months, and now we're seeing 3-year contracts being entered into. So the liner industry as a sector overall is probably in the best position it's ever been in, earnings visibility, and more so than that, the industry within probably the next 3 to 6 months is going to be debt free. And so there's a lot of wind at that sector's back as they look ahead. Even if freight rates fall, there's just a lot of ammunition for these companies to to continue to thrive.
Yeah, and to Omar's point, I think rates are certainly going to fall in the first quarter. They always do. Consumer spending slows, and Chinese New Year, you have the Beijing Winter Olympics, got to impact some of the factory production in China. That said, when you look at just the underlying demand, people are still spending money on goods rather than services. That's going to slowly head back to services, but we're not going to get to pre-COVID levels anytime soon. Inventories remain very low at the retailers, so that's going to take some time to replenish. And the biggest thing is clients I talk to just look at 2016 to 2019 and kind of call that a normal rate environment. Whereas in reality, that was like the worst 4 years in 20 years, right? So I don't think a market going down from here goes back to 2019 levels of less than $1,000 per TEU. Sure, it'll fall from whatever it is today, 4,000, 5,000, depending on the index you want to use, but it's not going back to 1,000. So yes, rates will fall. It's kind of like saying, oh, Capesize rates are going to fall from 85,000. Well, yeah, but they're not going back to 10 either. So I think the scale of the decline is important.
Yeah, I think we always, in bull markets, we always think there's going to be a soft landing, and there never is. And I don't know that maybe this time will be different, famous last words, right? But to the extent that the order book is going to be delivering about 10% gross fleet growth in 2023 and 2024 again, that's just a lot of ships to absorb, and a lot of time for consumer demand to potentially normalize, or infrastructure to be improved, and intermodal to work itself out. To me, again, it's certainly possible that things could end up being sort of, we just fall back to the median, but this is shipping, and the median is this ethereal place that we never really exist.
But I mean, the beautiful part with this industry is, of course, the earnings visibility, because obviously now you're seeing feeders being fixed for, as you mentioned, 3 years in the mid-30s, and if you look at the companies and the earnings for the tonnage providers at those rates, then you would probably be looking at multiples of 2 to 3 times. So I guess that MPC, for example, could probably be 35% yield over the coming 3 years if they stick to their plan of locking in these 3-year charters. And that's probably the best visibility you have, at least bar, long-term LNG contracts.
We have had cases in dry and in containers, though, that when the market crashes, those contracts just aren't honored. It's not quite the same historically as an oil majors contract in tankers or in gas.
That's probably a good point, but I think I just wanted to throw in there as well some numbers to the mix. I mean, if you try to track the global congestion numbers at the moment for larger container vessels, I think you're seeing up from a long-term average of 13% of the fleet kept up in congestion, now standing at maybe 28%. So I think once those numbers start to unravel, that's an extremely steep effective supply growth that you're going to see just on the back of that. And I think the interesting news that came out of the US last night with the Biden administration pushing for the entire supply chain to work together and eat through that overhang is something that might kickstart that normalization. It seems, at least to us, if you look at the aggregate number of what sort of volumes are being moved in this space now versus where you were perhaps all the way back to 2018, the growth on an annualized basis has been quite low. So we're just waiting for all these inefficiencies to start to unwind, and then I guess we'll see where we end up. But I feel it's hard to see at least in the underlying numbers, that a lot of that fleet growth, especially the ones that's going to materialize from 2023 onward, has anywhere to go, unless you think the volumes are going to see substantial growth from here on an aggregate level.
Okay, so let's move to another market that people are afraid of in terms of congestion, which is dry. What are our views on dry, everybody? Who would like to take that one up?
I'd be happy to start.
Yeah.
I think the dry bulk market is looking extraordinarily good. One thing to start where we are today, the markets are seemingly very tight. The freight rates are very high. I'm not saying that that's something that's going to consistently persist, but if you look at the underlying data and outlook for supply growth and just normalized demand growth going from here, considering what we've actually got in the order books today, that market is seemingly just going to be tighter and tighter in the coming years ahead. And then it comes a bit down to the short-term impacts, and then why we're seeing rates approaching $100,000 a day for the Capesize vessels. And I'd agree that some of that is the same inefficiencies that you're actually seeing in containers in terms of congestion, and perhaps even some spillover volumes, which I think is an important factor to follow on especially the smaller size vessels. But I don't know if any of the other guys on the panel can back me when I say that I couldn't find any historical up cycles where you've seen the similar tightness in the smaller asset classes that really drive the larger ones. It's rather been the other way around, and I find that as a very interesting observation in the current strength of the market, and could indicate that things are set to stay tight for still some time.
I agree, Jorgen. Sorry, Robert. I was just gonna back up, Jorgen. Exactly. I feel like we've gone through so many reams of data trying to understand and see in the historical perspective across different shipping sectors. Has any market recovery ever been led by the smallest ships consistently? And no, that hasn't happened before, as far as we've been able to see. And so it's definitely been good to see the handies drive the market during the first part of the year. And then obviously that strength parlayed its way to Supramaxes on up to Panamaxes, and now we've seen Capes. And what I find, and I agree with Jorgen's outlook on dry bulk, that it's interesting because over the past 20 years, dry bulk and China have been synonymous. And for really most of this year, there's been a lot of inconsistency from the Chinese steel markets and their buying activities across various commodities. And they've tried to control and rein in spending. But and we mentioned this, Robert, on our panel a couple of days ago, that pretty much ever since the Chinese took a step back from the steel market this past June, July, that's when the Cape market actually took off. And so there's a lot more players, a lot more countries involved in the dry bulk trade that have an effect that hasn't been there before. And I think that's what's exciting for the sector, is that it's no longer, at least for now, is not tied at the hip to China. There's more players involved and various commodities being moved in big numbers.
What would you guys like
more
to...
with, go ahead.
Go on, please.
No, I couldn't agree more with Omar. I think it's just as far as the stocks, I think a lot of investors are looking at these names up 200% this year. And a lot of headlines coming out of China making, for the story, maybe a little concern near term. But I think people needs to look at the supply growth. And I think once we see a more normalized demand side, I mean, if you compare 2020 and 2021, demand's been all over the place. And I think once we start seeing demand coming in over supply growth, I think we can have some good growth going forward. And we don't see a lot of ordering activity. So I think that's a good positive underlying support for the sector.
What do we want to see from so containers and dry are both like, crashing cash out like crazy at the moment. Many of you still believe that containers and dry stocks are trading below net asset value. What do you think these guys should be doing with this cash? You pointed out how strong some of their balance sheets are. In a couple of months, they're going to be really strong at these levels. Should they be paying dividends out, buying stock back, ordering new ships? Well, what would you guys like to see?
Yeah, I think a lot of them are doing what we'd like to see, right? Paying down debt, getting that to a very manageable level despite market volatility and the seasonality that we see, and then having a dividend in place, either be it a variable dividend based on cash flow or earnings, what have you. So ideally, you'd like to see some share buybacks, and a few companies have kind of instituted some of those authorizations, especially when you're trading at steep discounts to NAV. But in reality, if you get your net debt down to 20%, and if you're paying out pretty solid dividends really throughout the cycle, that should give you a premium valuation. So I think that strategy is likely going to pay off. It won't happen in the next few weeks, right? That takes time. That takes quarters of relatively stable earnings to really come to fruition. But that policy is pretty attractive.
I'm starting to have a change of heart on dividends, honestly. I think you look at it and say, well, the stocks, as you said, Robert, generally are trading below NAV. Feels like the equity markets are not as ready to chase equities above those NAVs. And ultimately, if that means that companies are prohibited or it would be really expensive for them to raise equity capital, well, then maybe you should retain those earnings, because the best way to make money in a shipping business is to buy when nobody wants to buy, but you have to have money to do that. So it might mean that you trade at a little discount to your high dividend paying counterparts when things are good, but it might also mean that you can eat their lunch when things are bad. So I'm kind of coming around thinking of it a little bit differently maybe than I have in the past.
We're also seeing there's another thing you could do is diversify, right? I mean, we've seen on the private side, some of the private owners, some of the Greek ship owners. We've seen Nolan as a public company who have had very strong dry container positions. In the last weeks, and I know for a fact, looking out at some of the few modern product tankers that are out there for sale, they've started to buy product tankers and started to buy tankers. We've even seen one public company, I don't know, for different reasons. I mean, I haven't really studied the company very well, but Navios effectively bought product tankers when they did their merger and effectively diversified. Do we see diversification with that cash through acquisition of markets that are still fairly weak, with perhaps their demand cycle still to come, as a good policy for the public companies?
I think, Robert, on this one.
Yeah.
We all want to jump in on it.
Yeah. The one thing that no investor, I don't think, has ever told me is, tell me the right shipping company to buy for the next 5 to 10 years. That's not what people are interested in doing. And I think if you're a private owner, you care about the next 5 to 10 years. And so maybe diversifying makes some sense. But that is not how the world thinks about the equities.
But Ben, you've said that before, and I completely agree with you that that's the current investor base, which is primarily hedge funds. Yeah, there've been a few mutual funds that have stepped in recently, but for the most part, it's hedge funds. And hedge funds are obviously very short-term focused. And as you mentioned in your prior comments about dividends, there hasn't been any benefit really to having a policy paying out a meaningful dividend. Now, that benefit existed the last bull cycle, where you got big premiums to NAV, but since then it hasn't worked. But I think you could actually perhaps change the investor base over time, because you have the mutual fund and long only landscape that's basically almost 10 times as big in terms of capital availability than hedge funds. But so far, shipping companies have modeled themselves to be very either spot centric or just live and die by the cycle. If you're able to diversify and you're able to live through all the cycles and capture market strength in the upturn and be able to invest in the downturn, you could then attract a whole wildly new investor community that currently doesn't exist, but could be there. I mean, that the capital that's there wants to invest in that type of strategy, a strategy where they don't have to worry about rates falling tomorrow, because they know management is deploying capital wisely, deploying commercially everything wisely. But I feel like there's a huge unlocked source of capital that the shipping industry at the moment isn't touching because of that lack of diversification.
Yeah, back in the 1800s, when I first started covering the sector, then there were no public companies. So you saw this experiment starting in 2000. I mean, there was a couple of companies public before then, but everybody was pure play on something, and there was crude, and then it was dry bulk, and And I think what history has shown is that you need more legs to stand on, and in order to deal with the cyclicality of the shipping business. So some of the successful private families, have diversified businesses. So I don't think that model has been given much thought by Wall Street, and I think in order to get, like Omar said, get some more long-term money into the sector, you need to extend the cycle and maybe reduce the volatility.
Yeah, and it's all on the investor base you're after. As Ben was saying, I want the double stock, then you want a very pure play, highly levered stock. If you want long-term, I want to buy it and not worry about it for 5 years, you want a diversified stock that is ideally paying a pretty substantial dividend. So it really all depends on the strategy and the investor pool that you're after.
I think it comes down to the assets. I think the reality is these are commoditized assets with zero barriers to entry that will always lend itself to cyclicality, and cyclical investors don't like conglomerates, period. In this or any other sector. Go look at truckload, for instance. It's come and go, has been for decades.
All right, so let's turn to another sector here. One of the, what I've noticed with Nick's conferences, the Capital Link conferences, it really has an ability to call the bottom on companies, because so many times I've come to Capital Link, and whether it's it doesn't matter whether it's the dry market that's in a mess or the container market's in a mess, and now the tanker market, everyone's waiting for it to get better. the sector that is not hot becomes very hot by the time we have one more year, right? So next year. And what's not hot right now, it seems from everything, is tankers. Yet, you know, in the last couple of days, you know, arguably the biggest dog that's ever been in tankers, John Fredrickson, has barked. And he's gone in with his own money. Thank you, whack. Takes 10.5% of a big company and puts that marker down and says, I think tankers are going to be hot. So what do we think about that, guys? Who's going to go against John Fredrickson here? Come on, one of you two Norwegians put your life at risk. So we'll let you two Norwegians comment on Mr. Fredrickson.
Yeah,
Lord of the Seas move here. Okay,
I'm certainly not going to go against him, because obviously, if you look at the market, it looks like you know, a pretty perfect setup for a steep recovery here over the coming 12 months, as you say. Well, it's similar to dry bulk in the sense that supply growth looks very, very manageable. And also on the demand side, obviously, demand for oil has recovered quicker than the supply side, but the supply side seems to start to move now. Obviously, we didn't see any extraordinary production hike from OPEC in November. But it will come at some point. And I mean, earlier this week, the EIA put out a massive 5.7 million barrel supply growth number for 2022. And I think it's quite fair to assume that a lot of that will be seaborne demand. So I think that demand side has probably bottomed out, and it's probably just a matter of time before owners start pushing up rates higher and higher, and at some point they will get the upper hand here.
I truly hope that the rates are going to get better considering where they are, and I think we're all in agreement that that's probably the way things are headed. But I'm
come on. He's not going to know. Mr. Fredrickson's not going to know what you say. Okay, this what you say to us here remains private, just amongst us. Okay,
good to know, Robert.
So
I think
is it the right decision or the wrong decision?
I think from his perspective, I think there are several stocks. If you look at how they're priced on a relative basis, you can make the argument that Euronav definitely screens attractive. It has the same kinds of assets, and they're very well familiar with how they're operated through what they've done together in the Tankers International pool before. So that doesn't really surprise me that you see an opportunity at some level. But considering where we believe the investor focus is, and I think it's, I'm not sure I agree with what you started the question with, Robert, in terms of the interest and where that lies between the different sectors. I definitely feel there's a lot of interest in tankers. So despite the market being being at very depressed levels, I do feel that the investor sentiment has been quite supportive at times, considering that the benchmark freight rate for a VLCC jumped from -5 to +5, and all of a sudden you were back at sort of high valuations again, and that's where I feel there's somewhat of a disconnect. I'm quite a simple guy in many ways. I see that the fleet has grown by 6%, and the bull case is that volumes are going to get back to 2019 levels, and I don't really make out where the difference of supply is going to be taken out in the near term. But it has, when you look further down the road, I agree, there's a structural supply that seems to be aging and should be taken out at the point in time But all the data points that we've seen so far point to an interest to keep a lot of these older vessels in the fleet still. And that's what we're struggling with. And that's where we need to see something happen, I think. And if the winter does disappoint and all of a sudden things weren't as strong this winter as you first thought, maybe that's what we need.
We appreciate, just quickly, if I may, we really do appreciate that, Jorgen. And look, if you need to seek asylum here in New York, I'm sure that Nicholas can arrange it. Okay. So,
yeah, and
Lars?
As you pointed out, Jorgen, it's a bit baffling, because if you look at this tanker market we've had this year, it's been even worse than 2018, right? Then obviously rates rocketed in Q4. So far that hasn't happened, and I mean, but obviously what's been going on asset values have kept shares higher this time around. So generally valuation has been better now than it was in 2018. And we've had a few false rallies, one before the summer, and yeah. So I have been a bit baffled by how well the shares have actually performed, given how poor the market has been, the underlying market.
Anybody got an explanation as to why the shares have performed, in inverted commas, so well?
Everybody likes to make a contrarian bet. I think that's how you make money in shipping, and I think you've seen some of those investors coming into the market. But I mean, asset values are up about 20% so for tankers this year, and we're seeing like we're just struggling along with the spot rates at cash negative, cash break even. So you know, if the rates don't improve this winter, I think some of these investors are already left, but we really need to see a recovery for people or investors to stick to these names.
I think that's right. I think there are some people who maybe were early investors in dry bulk or containers and have done really well. And then there's some other people that are kicking themselves for not having done so and are very eager to not miss that next cycle. So that's why we see the level of interest and the equities having been supported to the extent that they have been, I think.
Yeah, and I think people are just thinking to themselves, is there going to be more airline traffic next year than there is now, or less, right? So ton mile demand is going to grow for tankers. OPEC's going to produce more next year than currently. People are going to be driving and flying again. Refinery throughput is going to be increasing. Supply growth isn't massive. So all that being said, yeah, 22 is certainly going to be better than 21. So I think people are just getting ahead of that.
Okay, so natural gas. I mean, these rates have like skyrocketed. I mean, it is all over just general daily news, you know, breakfast programs and things like this, that natural gas prices have rocketed, that there's this huge arbitrage between the United States and Europe and Asia, and companies seem to be coming out with, you know, good sort of guidance on different things. Like Gola, for example, came out with guidance to profit shares, or things that matter to them because they're getting benefit of not just the rate being higher, but the price being higher. Yet the stocks themselves don't seem to have had any kind of real response to that.
Robert, yeah.
Anyone have any thoughts on that? I mean, it seems extraordinary to me. We're so programmed to rates go up, stocks go up, rates go down, stocks go down. And in gas, it's like rates hit the roof and nothing happens.
I think Flex LNG would argue with you on the stocks not having done anything.
Okay, what have they done in the last 2-3 weeks?
Okay,
it's a relative.
Fair enough. Good point. Not over
the
last 2-3 weeks.
Yeah.
Yeah, I think part of it is everyone knows LNG rates are seasonally stronger from October to January. So I don't think anyone's surprised that, LNG rates are going higher. That said, the equities certainly have not matched the LNG prices or LNG rates. I just got done hosting the LNG panel, and we talked at length about that and how with higher LNG prices come more geographical arbitrage trades. There are very few, if any, real spot availability vessels out there. Flex has a couple, but Golar, for example, just signed away their last LNG carrier through at least March of 22. So they have no exposure on the spot side. So part of it is that, although rates are going to continue to climb, how much exposure do some of these public equities have to those rates? So we'll see. But obviously LNG prices are very robust, and they will stay that way for at least the next few months.
Great. Anybody like to chip in, talk about something else on your mind?
You know what, Robert, I will throw this out. I guess it's funny. It's been a year, but a year ago on this panel, I feel like it was Capital Link of last year. Hugh Crooks was moderating from Ridgebury, and he actually was asking about LNG. And at the time, LNG was sort of that left for dead, I guess, as the transition fuel even. And he was asking if we had dialed back our growth expectations for overall LNG growth and natural gas growth. And here we are a year later, and it's the exact opposite type of conversation. So a lot can change, and we know that, right? It's shipping, and we're in the middle of it, and things can change tomorrow. But it's quite interesting that a year ago on this at this panel, we were lamenting the demise of LNG, and here we are in 21 talking about how there isn't enough, and there's massive price dislocations. And look, private equity came in here earlier in the year and just started taking these companies private. They saw a cash machine potential over the long term. And so, part of the reason why the equities haven't performed well is not that many exist anymore, Robert. We've lost several of them into private hands.
Those that do have still made quite an improvement, at least from the levels you had last summer. And I completely agree with you, Omar, that I remember speaking to investors back in September, October of last year, and there was little faith that gas seemed to be part of the solution. And I think that's completely flipped around now. And that's a good indicator, I think, for what may come in this space, not only on the LNG carrier side, but also some of the names that work on the upstream and infrastructure side to get LNG to market. And that's also part of the question here. How do you do that in an effective manner in a short period of time in order to cater to this demand that probably is set to stick around for still some time? And if you continue to see this growth coming, then I guess this kind of gas price and energy environment might not be that unusual, perhaps going forward, seeing as how things develop. So, especially on the we mentioned Golar, and I mean the FLNG business at the moment with this backdrop that you're seeing makes quite a compelling case. I like to highlight in terms of time to market and economics at the moment. So. This is just perhaps just a look into what may be a larger part of the future in terms of energy prices going forward, and that's an interesting aspect.
So if we look into, say something, trying to do a few fun things here. So let's say we're looking into the future. At some point, I don't know whether it's going to be 2030, 33, 34, we're going to have renewables starting contributing properly to the energy, etc. Maybe we're reaching, peak oil ton miles or product tanker ton miles in that time. Already, we haven't even started a recovery. You can't get, there are not many product tanker berths or crude berths that are open, even in 24. We're starting to get to 25. Well, if it takes a little while for the market to recover and we get to berths not open until 26, then is there actually any point in anybody ordering a new tanker for delivery 26 where it may only have 5 years in premium markets before the demand sort of goes down, or 6 years?
Yeah, I think so, Robert. I think you should. I would. You mentioned we're in the 2030s and renewables have, taken a bigger slug and maybe tankers or oil has peaked. I would point out, though, that a lot of that, those forecasts and projections are probably outdated at this point. We're in a period where everything is just thrown up and we're just trying to figure out now what's the way forward. This massive energy crisis with prices through the roof, I think is really going to reset the thought process. It's still early, but you still have the green transition is still full on, but is the capital going to be there for that? Right now, that capital has been, it requires time, and you need a series of years to pass before you can actually start to see a return. But right now, you're compelled, if you're providing capital, to invest something closer to where you're going to get a return today. And that's what's being offered today across the different commodities. And so I think it's going to, for us to be able to truly answer that, Robert, I think these next 2 years are going to be very interesting to see where does the capital flow? Does it continue going into renewables, or is it going to start to come back towards the conventional? And so, yeah, there's still a big question mark on that. But I would also, about ordering a tanker in 26, I mean, you do have still a very old fleet at the end of the day when we get to that point. I think today, looking at tankers, I want to say a third of the crude fleet, or probably the overall fleet, is 15 years or older. And so a third isn't going to just go away in 5 years' time. We're going to need to replace that. So you should continue to order.
Okay. And I think also it's probably worth noting that, okay, even if oil demand might peak, it's a peak, it's not the complete fallout, right? So there will still be demand for oil. I think that it's fair to assume that the first sort of leg for the supply side of the oil to adjust would be probably OECD countries and not necessarily the oil exporting countries. And I think that's a key as well. So the last man standing here will probably be Saudi Arabia, right?
Yeah. So Magnus, what's on your mind?
Oh, we're going to commit to stock picking. You only have 5 minutes left.
And whatever you want to do, stock picking, guys. We can do stock picking if you want. We do whatever you want. If you're the only one who wants to do stock picking, that's okay with my Magnus. So you go first.
Well,
so that we can make sure.
Aren't we having some investors on this call? They're trying to figure out what to do out of this, So they should go home with something to think about.
Sure, go for it.
Oh, you're asking me?
Yeah.
Yeah. So, okay. One stock per person, I guess. So I'm just going to mention one. It's International Seaways, INSW. It's a diversified play on the crude and product tanker market recovery. The merger with DSSI is highly accretive. I don't think investors realize how accretive it is to bottom line, but we're looking at 45% accretion. And then finally, the valuation looks really cheap, 45% discount to NAV. And it's trading like at a 2 times EV/EBITDA next year. So we like the name, and I think it will be re-rated when you compare them to the closest peers like Frontline, Euronav, and DHT.
Great. Let's go for Randy. Randy, you next. I'll tell you what, you can go for 2, okay? So I'll come back with your second one, Matt. It's a bit tough just going for one. You put too much pressure on your investment banking groups. So
give me 2 here. Magnus stole one of mine, so I'm actually going to get 3 out of it.
Wow, you're going to get 3.
I'll go with the GLNG. Golar, we talked about all the reasons why. LNG shipping, FLNG, the LNG carrier spin. They just did all the refinancing. The converts are finally taken care of. And then I would say a dry bulk entity with a large dividend payout policy and Cape-size spot exposure. Genco, Star Bulk, those are my picks.
That's fantastic. You managed to get 4 at least there. That's brilliant, Randy. Excellent job. Okay, Lars, you go next.
Yeah, and I think I already kind of mentioned it, but I think that the durations that you will see MPC fixing over the coming months and quarters, and at those rates that they will actually achieve on those fixtures will be simply too compelling from a cash yield perspective. So 2 to 3 times earnings for the coming 2 to 3 years and dividend yields of 30-35%. I think that's very attractive.
Thank you very much, Jorgen.
Yeah, I'll stick to one because I also agree with Randy. So, but I'd throw Gold Motion into the mix with the Capesize exposure on dry bulk. But if I were to pick something else, then a bit out of the ordinary perhaps. But you've seen what's been going on in the container space, and I just very much like to highlight what's been going on in the car carrier space as well. If you look at the inventory levels that are set to drive this cycle extension in the container space. To me that seems a bit weird, because if you adjust for the auto sector in the US, it seems to us that the inventories are actually quite high, which is a bit mind-boggling. But if you do the same exercise for just auto volumes in the US, they're completely bombed out. It's probably the one sector where you're looking at maybe years to replenish the inventories that you need, looking forward. So in terms of the chip shortage becoming an item of the past, and that clog getting out of the way, I think the volumes in that space are set to pick up considerably, and you've already seen the time charter market start to replicate what we saw in the container space, and there you do not have any order book, and the fleet is on average above 14 years. So I think that space is just looking magnificent going forward.
Great. And Ben and Omar.
I like that car carrier idea. I'll be counter cyclical. I'll go with Navigator gas. In keeping with what Omar was saying earlier, a year ago at this time, people said LNG is just going to be awful, and here we are just sort of scratching our heads saying, boy, didn't see that coming. People are worried a little bit about the LPG order book, but guess what? If oil prices stay where we are, that rig count is going higher every single week, and that means that US oil and gas is going to be at a competitive advantage relative to anywhere else in the world, and in every single well they're drilling, they're getting NGLs, and that has to be exported somehow or another. So I think, looking for things that have been sort of overlooked and unloved, that's probably where I'd focus for kind of a dark horse idea.
Great. Omar?
Yeah, thanks. Robert, 2 days ago I mentioned GLNG, but Randy took that. But I would highlight Zim. I know it's been the stock has performed extremely well, but the company trade. I'm just looking at my screen. The stock is at $43, and it's probably with a decent amount of certainty going to at least earn $30 of EPS this year. And I think most people believe that that's it, and we're done. And now we kind of go into a moderate outlook, but there's an increasing chance that 2022 could end up being just the same as 21, with companies entering into freight contracts. So I think Zim is definitely worth a shot, especially as they intend to pay out a big dividend early next year with this year's earnings.
Okay, I'm just going to do something just for super fun here. So give me one thing that you think crazy, however crazy it could be, that should be on every public board's list of, what crazy things could happen that will either be good or bad. And we'll start with you, Omar.
Okay.
Anything totally unexpected that could be good or bad. It doesn't matter.
Robert, maybe it's sort of this is the question that I heard, and I'm going to answer this from what I believe I heard you ask.
Yeah, perfect.
One thing we haven't talked about this in seemingly years now, but it's the quote unquote shadow fleet that has tended to be talked about whenever times are good. that you have the shadow fleet that emerges where companies speed up vessels. I've been surprised that we actually haven't seen any of that. If you look at the container fleet from worst of the pandemic to where we are today, the fleet's gone up by maybe half a knot in speed. Dry bulk vessels from the same thing, from 0 to where we are today, have gone up maybe also half a knot. LNG, LPG, vessel speeds aren't increasing. And maybe part of that is you're just going to create more congestion, but I don't think that's just it. And so I feel we're in this situation now where vessel speeds may not actually ever speed up again to levels that we think they could get to in a very bull market. And so I just find that interesting.
Perfect.
From extremes.
Randy?
I was going to say there was going to be a global speed limit imposed, but taking that off the table, there will be a dynamic weather event in France that really changes the trajectory of LNG imports into Southwest Europe over the next 1.5 to 2 years.
Okay, that's fine. That's good. Lars?
Well, I think one possible consequence of what we've seen over the past year is obviously a super restocking cycle in across all commodities and goods. I mean, countries and consumers and everyone, they would like to avoid ending up in the same situation again. So I think ship owners should be ready for that.
Great. Jorgen?
Yes, I'd go for a nutty professor in some shed, finding a way to cheaply make e-fuels, liquid e-fuels that make tankers the thing of the future and not the past. I think that would be perhaps the most interesting thing that could happen, because that's not in our estimates, at least.
Not for any self-interest. I really like that idea. Ben?
I'm going to say we're going to see some mega mergers in some of the companies that we see today. Maybe one of the companies we see today could be a 500 vessel fleet with a $10 billion market cap.
Is that why Fredriksson's buying Euronav shares?
Jorgen, he's real tight with John, I think.
I think we lay off these guys. They put their lives at risk earlier. Okay, that's enough for that. It's a Magnus. You get the last word. Okay,
All right,
the second
great.
last word. So I got to sum up.
All right. Well, all the companies been extremely busy over the last 2 years with adding ESG committees to their boards. And I see a trend over the next year that will be another committee added, with starting with an E as well, an ECC committee, Energy Crisis Committee, which should be good for tankers.
All right. Thank you, everybody. Hopefully the audience has enjoyed it. I think that's been really, thought-provoking and very good. And Nicholas, once again, thank you for everything that you've been doing for us all in the industry, and appreciate it very much.
Robert, my thanks go to you and to all of you guys for actually, you're the ones really driving the industry. And I'm gratified to have the opportunity to work with you and also to enjoy your friendship and support, for which I'm very grateful. This was a great discussion, I have to say, always very spirited and always very insightful. I felt like coming in a couple of times to give my opinions, but then I stayed on the sidelines that I should be as the organizer. So, but thank you very much to all of you. It's been really terrific. And actually, when I look back at these 3 days, it is amazing that we were able to put together such high caliber panels throughout the industry, all the topics, great attendance. So wonderful way to end the forum. Thank you, Robert. Thank you, Ben, Lars, Jorgen, Omar, Randy, and Magnus.
Yeah, thank you, Nicholas.
Yeah.
Thank you, Nick.
Thanks, guys. Thanks.